School of Management Studies IGNOU presents an audiobook on the course MMPC 004 Accounting for Managers for MBA program. Presenting Block 1 Accounting and Overview, Unit-3 Financial Statements, Part-2.
Profit and loss. So far, we have learnt about the various revenue and expenses arising during the course of business operations and shown in the trading and profit and loss account. Broadly, we understand that profit is the excess of revenue over the expenses recognized during a fiscal year or accounting period. Conversely, loss is the excess of expenses over revenues realized during a fiscal year. However, the significance of dividing income statement into trading and profit and loss account lies in the presentation of gross profit and net profit respectively. Besides, business entities are also interested in ascertaining the profit arising solely from business operations referred to as operating profit. Gross profit. The excess of sales revenue over the cost of goods sold is called gross profit, whereas gross loss is the excess of cost of goods sold over revenue earned from sales. It only deducts the direct expenses related to the production of goods. Hence, it is the net result of a trading account. Gross profit taken as a percentage of sales is a significant financial ratio used in financial analysis by managers for decision-making purposes. This percentage indicates the average markup obtained on products sold. Thus, gross profit equals to sales minus cost of goods sold, and gross profit ratio equals to gross profit or sales into 100. Gross profit or loss is transferred to the profit and loss account. Next comes operating profit. Operating profit is derived from gross profit. It reflects the remaining income after deducting all the operating expenses. In addition to cost of goods sold, these expenses include rent, insurance, salaries, administrative expenses, selling and distribution expenses, as well as amortization and depreciation of assets. All those expenses that are necessary to run the core business operations must be taken into account to arrive at the operating profit. It is the profit from core business operations before deducting interest and tax expense. It is also referred to as EBIT, that is, earnings before interest and tax. Therefore, operating profit equals to gross profit minus operating expenses including depreciation or amortization. The idea is to separate the income earned from production and sales from the other non-core activities of business. Net profit before tax. Net profit before tax is the surplus of all business income over all expenses including interest but excluding tax. This is the profit available to the business entity as a result of both operating and non-operating activities. This profit is usually referred to as PBT or profit before tax or EBT, that is earnings before tax. So the equation becomes net profit equals to gross profit plus other business incomes minus indirect expenses excluding tax. Net profit. Net profit is simply the amount which is available to the business for appropriation. It is the net income from both operating and non-operating business activities after reducing both direct and indirect expenses. It is either distributed as dividends to shareholders or owners or retained in the business as retained earnings, thereby increasing the owner's equity in the business. Alternatively, it is called as PAT or profit after tax or EAT, that is earnings after tax. After dividend distribution, if any, the remaining surplus is added to the retained earnings. Retained earnings accumulated over the years is shown in the balance sheet under the head Reserves and Surplus. Net profit impacts the decision of various users of financial statements such as management, investors, creditors, competitors, etc. For example, creditors refer to the net income of a company to gauge the repayment capability before sanctioning a loan. Income statement. The balance sheet represents the summary of the assets, liabilities, and net worth of the business at the end of an accounting period. In a way, it summarizes the net effect of business operations and transactions made during the accounting period. However, it does not disclose anything about the business operations. What was the sales volume and revenue? How much direct and indirect expenses were incurred? What was the amount of operating and non-operating income? How many purchases of raw materials were made? All these answers are in fact addressed by the income statement of the business. Income statement is also commonly referred to as profit and loss account. It discloses the business's revenue, cost of goods sold, gross profit or loss, selling and administrative expenses, other non-operating expenses and income, taxes paid, and net profit or loss in a coherent and logical manner. The profit or loss is determined by taking all income and subtracting all expenses from both operating and non-operating activities pertaining to an accounting period. For a systematic determination of gross profit or loss and net profit or loss, income statement is divided into two sections, namely trading account and profit and loss account. Preparing a trading and profit and loss account. Having understood the basic concepts of income and expense as well as revenue recognition, we shall now prepare a trading and profit and loss account. It is also commonly referred to as profit and loss account or income statement or statement of operations. It is a final account that shows the summary of all revenue and expenses recognized during the accounting period, the net effect of which is reflected in the profit earned or loss incurred. Thus, revenue minus expense equals to profit or loss. Some fundamental rules must be kept in mind while preparing a trading and a profit and loss account. They are: number 1. The profit and loss account has two sides, debit and credit. We must debit all expenses and losses and credit all income and gains. Debit balances are shown on the left hand side and credit balances on the right hand side. Number 2. The incomes and expenses must relate to the current accounting period. Number 3. The balances of expenses, incomes, losses and gains are taken from the trial balance. However, there might be some omissions or corrections in the trial balance which need to be adjusted in the profit and loss account if they relate to current year. Number 4. Trading account represents the gross profits or loss from the core business operations. And number 5. Profit and loss account represents the net income or loss from all the operating and non-operating activities of the business entity. As we learned, the profit and loss account takes the balances of revenues and expenses from the trial balance and adjustments are made for any additional information. Let's start with the preparation of trading account. Trading account records the sales revenue and cost of goods sold for the accounting period, the net effect of which is represented in the gross profit or gross loss. The gross profit or loss of the trading account is then transferred to the profit and loss account, against which all indirect expenses are set off as well as any other non-operating income is added. All expenses are shown on the debit side and incomes on the credit side. Summarizing the income statement, that is profit and loss account. Profit and loss account is one of the three final accounts generated by the business at the end of an accounting period. It shows the gross and net profits or losses generated by the business in an accounting period. Therefore, it's a measure of management's ability to generate income from assets. Profit and loss account is divided into two sections. Trading account reflects the earnings from core business operations in the form of gross profit or gross loss, whereas the profit and loss account summarizes all the operating and non-operating revenues and expenses in the net profit or loss. The revenues and expenses recorded in a profit and loss account belong to the current accounting period. Profit and loss account is also commonly referred to as the statement of profit and loss or income statement or statement of operations, etc. Its preparation is based on the accounting principles of revenue recognition, matching, and accruals. The net profit or loss sustained by the business as calculated by the P&L account increases or decreases the retained earnings in the balance sheet respectively. Balance sheet. The balance sheet, as the name suggests, is the summary of the balances of the various assets, liabilities, and capital accounts of a business entity as on a particular date. In simple terms, it is the summary of things owned by the entity as well as the claims against those things represented in monetary terms as on a specific date. It contains information about both the resources and obligations of an entity. Thus, it depicts the financial position of a business at a given point of time, which is usually the close of an accounting period. It also depicts net worth, which is just one part of the balance sheet, which is also the total shareholders' funds. Balance sheet depicts financial position as on a particular date. In brief, the various aspects of a balance sheet can be put as: Number 1. A balance sheet is a financial statement prepared from the point of view of a business entity, firm, or company, and not from the point of view of its owners, investors, directors, creditors, etc. Number 2. A balance sheet is a statement and not an account. Number 3. It is a statement showing the financial position of the business entity on a specific date. Number 4. It is a historical report showing the cumulative effect of past transactions. Number 5. A balance sheet always relates to a particular point of time or date and not a period. Number 6. A balance sheet depicts the resources owned, that is, assets on one side, and obligations or liabilities of a business entity on the other side. Number 7. All items on a balance sheet are represented in terms of monetary value. And number 8. The total of both sides on a balance sheet are always equal. Let us understand the concept of a balance sheet with the help of an example. Mr. Raghav is the owner of a startup firm RT Limited. On 1st April 2020, the position of his business firm RT Limited is as: he has invested his personal savings worth rupees 10 lakh cash into the firm as capital to start the business. He also took a loan from bank of an amount equal to rupees 3,50,000 for buying office premises for his business firm. Further, he purchased some machinery worth rupees 2 lakh and a motor car worth rupees 3 lakh for the operations of the firm. To start the business operations, he brought in inventory worth rupees 2,50,000 and kept an amount of rupees 20,000 as cash and also deposited an amount of rupees 50,000 in a bank account for the purpose of business. Apart from this, Mr. Raghav invested the remaining amount of rupees 1,80,000 in government bonds on behalf of his firm RT Limited. Now let us generate a balance sheet for RT Limited as on 1st April 2020 on the basis of given information. We will classify the given information into the resources owned by RT Limited and the claims against those resources. The commonly accepted format of balance sheet in India shows liabilities on the left-hand side and assets on the right-hand side. As already discussed, a balance sheet is always prepared from the point of view of a business entity and not the owner. Here we can see that the total value of resources owned by RT Limited, which includes building, machinery, car, cash, investments and inventory, is worth Rs 13,50,000. In accounting, these resources owned by the business are referred to as assets. Further, we observe that the claims against these resources in the form of bank loan stands at Rs 3,50,000. Such claims against business entities' assets are referred to as liabilities. Now the net worth of RT Limited will be calculated by deducting the claims against its worth from its total worth of resources, which is an amount equal to Rs 10 lakh. That is 13,50,000 minus 3,50,000. Thus, the net worth of an entity represents the claims of its owners, which is also referred to as owner's equity. We also learned that the items of monetary value possessed by an entity are referred to as assets, whereas the amount owed by an entity which represents claims against its assets by outsiders are called as liabilities. Thus, we can say that the position statement is a summary of the assets, liabilities, and net worth of an entity at a specific point of time. Dual aspect concept. Let us take a step further in the previous example. Suppose Mr. Raghav purchased some goods or raw material worth Rs 10,000 in cash. This transaction will have a dual impact on the balance sheet of RT Limited. First, the inventory will increase by Rs 10,000 and second, the cash balance will decrease by Rs 10,000. Similarly, if the goods were purchased by Mr. Raghav on credit for Rs 10,000, the inventory or asset will go up by Rs 10,000, whereas the creditors will also increase by Rs 10,000. This brings us to a fundamental accounting concept known as dual aspect in accounting. This concept explains that each transaction made by a business entity impacts the business in two different aspects which are equal and opposite in nature. It means that every business transaction will affect at least two accounts, which implies that for every debit there is an equivalent credit and vice versa. For example, if your company borrows money from the bank, the company's asset or cash is increased, that is debited, and the company's liability, that is notes payable, is also increased, that is credited. It is because of this feature that both sides, which means assets and liabilities of the balance sheet, will always be equal. This concept forms the basis of double entry accounting and is used by all accounting frameworks for generating accurate and reliable financial statements. The dual aspect concept is also explained in the fundamental accounting equation as assets equal to liabilities plus owner's equity. This accounting equation indicates that an entity's assets have to be equal to the sum of its liabilities and owner's equity. This equation is considered to be the foundation of double entry system of accounting. It ensures that every entry made on the debit side has a corresponding entry made on the credit side and vice versa. Hence, the double entry made will automatically balance the accounting equation. To sum it up, we can say, number 1, an increase in assets is followed by an increase in liabilities and or equity and vice versa. Number 2, a decrease in assets is followed by a decrease in liabilities and or equity and vice versa. Number 3, an increase in an asset is followed by a decrease in another asset and vice versa. Number 4, an increase in a liability is followed by a decrease in another liability and vice versa. Now let's consider a series of examples to explain this concept further. Mr. Raghav further invested cash worth of rupees 4 lakh into his business RT Limited. The effect of this transaction will be: number 1, capital will increase by rupees 4 lakh on the liabilities side. Number 2, cash will also increase by rupees 4 lakh on the asset side. Also, Mr. Raghav repaid the loan in cash he took from the bank for his office building worth rupees 3,50,000. The effect of this transaction will be: number 1, loan from bank will reduce by 3,50,000 on the liability side, and cash will also reduce by rupees 3,50,000 on the asset side. Lastly, Mr. Raghav sold the investments he made in government bonds for rupees 2 lakh cash. In this transaction, RT Limited made a profit of rupees 20,000 as the gold bonds were purchased for rupees 1,80,000 initially. The effect of this transaction will be shown as: number 1, investment in government bonds will reduce by rupees 1,80,000 on the asset side. Number 2, cash will increase by rupees 2 lakh on the asset side. And number 3, profit of rupees 20,000 will be shown by an increase in capital on the liability side. Hence, a balance sheet will always balance its two sides. The effect on one account will be compensated by an equal and opposite effect on another account.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program course code MMPC 004 Accounting for Managers. Course Coordinator Professor Kamal Bagrecha, School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Ruchi Sharma. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.